Hi everybody, Alex Deployer from Expert Forex, and in this video we're going to be talking about a tool that you can download today that helps you manage your exposure to leverage and margin requirements. Now this is important not only to robot traders but to every single trader that uses a broker account. So if you have a small account, margin management is even more important because you could get a margin call and still be profitable in your account, strange as it might sound, because the margin requirements have increased so dramatically. Or if you are competing in a trading competition, sometimes you have to take risks that are above average and they will invite margin calls a lot earlier, and this tool can prevent you from experiencing those margin calls. If you use a technique that opens a lot of trades at the same time, margin management becomes increasingly important. Sometimes, unfortunately, you would also start trading a losing technique, and when you are losing, there are two factors that are pushing down on your margin requirements. Firstly, the loss that you're making is increasing, so your available finance or capital in your account is going down, plus your margin requirements are always still there, so it's a double requirement that you need. You need money to finance your margin requirements as well as money to finance your losses. And if you are a high risk, high return trader, the ones that make a lot of money, you are invariably taking position sizes that are a little bit bigger than normal, and therefore your margin requirements are bigger than normal, and you need to manage the margin requirements. Now the first question that you might be asking is what are these margin requirements that we're talking about? And essentially, in a very simplified way, what happens is when you buy a currency or you sell a currency, the broker has to go out and buy that basket of currency that you're trading. Therefore, the broker has to spend money. But the broker doesn't like spending all of their money. So what they do is they say, hang on, you've got to pay some of the money that I've got to spend to buy this basket of currencies, and that is essentially the margin, your margin that you have to pay. In some cases, only 1% of the capital requirement. So if you're trading, let's say, $100,000 basket of currencies, the broker will say, hey, finance 1% of this, and that's must be $1,000. Now that $1,000 is your margin that the broker takes out of your account and says, okay, I'm holding that as margin for you. The minute you close the deal, that margin goes back into your account. So it's just a temporary deposit, but it can cause your account to run out of money. And what's made it worse is that the margin requirements have been legislated to go down in many countries. Recently, Australia has gone down from leverage, which is just one way of expressing margin, of 200 to 1 down to 30 to 1 for Forex trading instruments. That means the margin has increased from you having to put down 0.5% of the currency package that you're trading to you now having to put just over 3% in as margin. And I'll show you an example of where you can see what the margin involved is. So let's look at a typical trading account that is busy trading at the moment. You can see there's a balance of $4,500 in this particular account. And then your balance consists of your initial deposit that you've made into the account, plus or minus the results of your closed deals. So if you've had positive closed deals, your balance would go up. If you've had negative closed deals, it would go down. Also, you could possibly have withdrawn money from that balance. So your balance is basically initial money, profit and loss to date, less withdrawal. So that's what your balance is. Now the equity is actually what you should be looking at in terms of profitability, because the equity says, hang on, balance only takes into account closed deals. equity takes into account open deals. So now you'll see in this particular account there are deals of $83. There's a negative balance of $83. So if you come and have a look here, you'll see that the equity is $83 less than the balance, because equity takes into account your open deals. So that when you're trading in terms of profitability, you should be watching your equity. But these open deals require the margin that I've been talking about, and that's where you see how much the broker is taking in margin. So to finance the 2 open deals that are running at the moment, the broker has taken $450 to finance those particular deals. So that is actually taken out of your available money that you have in your account. And if you take the equity less the margin, you get what we call free margin. And the free margin in this case is $3,900. So that is why when margin becomes a big number, watching your balance is useless, watching your equity is useless. You need to watch your free margin, because that's going to tell you whether you're going to have a margin call or not. This account is still quite away from having a margin call, but this is what the tool manages. It manages that free margin for you. Now, if you've never experienced a margin call, or you've never traded in high risk environments, this will not mean much to you. But those who have had a margin calls before will realize how important free margin is. So very simply, what does this tool do? And let's say you start out with an account of, let's say, $10,000, and you say, look, I don't want my free margin to ever go below $3,000 or $2,000. So firstly, you make your mind up, that is the level that you want to start controlling margin at. Above that, margin doesn't play much of a role, because it's if you've got enough capital in your money, in your account, and your account is doing well, margin won't play a role. It's only when you start either making losses or you start opening lots of trades that margin then plays a role. And then you say, all right, I don't want to let margin become a problem in my account, and therefore I need to start managing margin. And how do you manage margin? Firstly, you don't open trades that will result in your margin going into dangerously low levels. So that's the one thing that you do. And the other thing you do is that if your account starts making losses and it's going lower and lower into these dangerous margin levels, you have to close some of the accounts to release the margin that was held by the broker before. So you close accounts to release margin back into your account, and to make your account healthy in terms of margin management. So this is what this tool does. It prevents you from opening trades to a level where your margin becomes dangerous. And what is a dangerous level? You decide on that. You can decide if you've got a $10,000 account, you might decide $3,000 is a dangerous level, or $2,000 is a dangerous level. If you've got a small account of, let's say, $300, maybe then $1,000 would be your dangerous level. So all you have to do to tell this EA is, this EA only has one input. So all you have to tell this EA is what is the dangerous free margin level, at which level you want to start closing deals or stop opening deals to cause it to go into those dangerous levels. And the EA will do that for you. And that's the purpose. You don't have to do it manually. You can sleep through this process. The EA will automatically close deals or not open deals that will result in your account going into dangerous free margin level. It will normally close, strangely enough, the most positive deal, so that it releases back into your account the most money it can. Now, all of this talk about margin management and that is a little bit advanced, but it is a critical skill that traders have to develop to manage their accounts. Lots of traders have come to us and said, my account is positive. In other words, the person is making lots of profits, but because they've opened too many deals, they have resulted in a margin call. So margin management is becoming bigger and bigger every day, and this tool is an essential tool to help you manage margin. We are looking at building this feature into all of our EAs so that traders can manage their free margin in most of our EAs. At the moment, it is a freestanding tool. Okay, so now the question is, where can I get this tool? Okay, so the tool is available to our premium members in our paid forum. You go along there, and I'll give you a link of this to this forum in our description, as well as in the commentary to this video. So it is part of the free forum. If you're not a member, you can go and join there. Currently it is $29 a month. And if you go down to the benefits, you'll see number one benefit is premium trading robots and indicators. So in there's a whole long list of indicators and EAs that you can download as a member of this forum, and I'm going to just click on that, and there is the margin guard. We call this the margin guard. It is a trading robot. It monitors your whole account, so you might have a few other EAs running, but it will monitor your whole account to make sure that your account doesn't run into margin call problems, and it will manage your account while you sleep. So there it is. You can go and download the margin guard today. As you can see, I have just loaded it. There's just a few people that have started looking at it, and I'm sure after this video a lot more of the premium members will be downloading this tool. Now, I hope you've learned something about margin management and the dangers of how easy it is to get a margin call in spite of your account being having a nice positive balance. So from me, Alex de Proy, cheerio.